Good afternoon and welcome to another Impact Insights. I'm delighted to have with me today Chris Kirby, who is the Head of Specialist Distribution from the Mortgage Lender, or known as TML. Hi, Chris.
Hi, Dale. Thank you for having me join you.
Thanks for being part of this today. It's great to be back and see people face to face for a start, which
Most
is great.
Definitely, yeah, definitely.
And what you're going to go through today is who TML are and what they can do or what they can offer our broker partners out in the marketplace. But Impact are one of the approved packages for TML, so Chris will go through that as well. And so we have some exclusives in the LUMI range that we'll cover as we go through. So I'll hand over to Chris for now to go through the presentation, and then I'll come back with other questions as we need to.
Cheers, Dale. Yeah, thank you. So really what I wanted to do today was just sort of give you a sort of a high level overview of around the sort of, you know, our four pillars of lending. So the main reasons that customers are placed with TML, so the main bulk of our business, but also as well just provide a little bit of commentary as to what's going on in the marketplace, the mortgage market at the moment, and hopefully that will give you a better understanding as to why more and more customers are engaging with specialist distributors like Impact, and more residential customers especially are coming to a lender like TML. So just to give you a bit of a background as to who TML are as a lender, we're an independent business. We're wholly owned by Shawbrook, but we are our own separate entity. We operate very much in the specialist mortgage market. However, we don't necessarily feel that what we do is specialist. You know, one of the things that we pride ourselves on is our customers are normal customers. They are people that you as a broker will be seeing every single day, and their circumstances may not be too abnormal, but they just don't meet the high street mold. And this is very much where we come into play. Okay, so what I've done is I've broken it down into sort of like four key areas, and I'll cover them off one by one as to the main reasons that customers are being placed with TML by their brokers via people like yourselves at Impact. Okay. So on the next slide, one of the main areas that we do a lot of our lending, I'll say over half of our residential lending, is in the self-employed market. So if you look at the self-employed market, just a bit of a background, again, high level overview of it. Post the previous recession, sort of, you know, 2008 to 2012, the number of people who are self-employed increased significantly. It's estimated there's now around about 5 million people who are self-employed in the UK. COVID and what's happened over the past 18 months, 2 years, has seen a big spike in the number of people, again, that have gone self-employed. So in 2020 alone, there was 835,000 new businesses that were registered in the UK. That's not to say that all of those businesses will have survived, and that's not to say that all of those businesses will have been for mortgage age customers necessarily, but you'd expect a big proportion of those people are of mortgage age. And what you are going to be seeing now is that a lot of those customers are going to have only just 1 year's accounts, which can be quite a barrier for a number of these people to then actually get a mortgage with a high street lender. And this is where specialist lenders and specialist distributors especially come in really, really handy because of your knowledge of what lenders will support this type of customer.
Yeah, and we need to also get to that consumer as well, because they bury their heads in the sand. I think they can't get a mortgage if they've only got 1 year's accounts. That's a big thing at the moment.
Absolutely. A lot of people who you've got a bank account with a high street bank, your initial thought is, I want a mortgage. I'm going to go to a bank with, or who my mum and dad bank with, because that's the logical process. They say no, and for a lot of customers that journey ends there. They think, oh, I'm self-employed, I actually can't get a mortgage. But actually no, what we're saying ourselves as a specialist lender is you absolutely can get a mortgage with 1 year's accounts. And this is where we can provide a solution for you. And what I would absolutely say is if you've got a customer who has got 1 year's accounts, or there's other areas of our self-employed criteria which is especially supportive of the self-employed market, we can support people whose incomes have been impacted by COVID, for example. We do net profit before corporation tax when we lend. So when we're looking at affordability being a bit of a challenge and the cost of living going up, we have absolutely got those solutions out there. So what I would absolutely recommend is speaking to Impact, speaking to specialist distributors to make sure that you are exploring all avenues for your customers. If you don't know about certain lenders, that's not a problem. Specialist distributors absolutely do. The next part that I'd want to talk about is complex incomes. And this links again, we're talking about one of the big challenges in the market is when we're talking about the cost of living. It's only going up. You know, my gas and electric bill has more than doubled, which poses a challenge in itself. But then those customers where house prices are going up significantly quicker than what wage inflation is going up, this is where people are looking at ways they can maximize their affordability. So I've already touched upon how we can do that for self-employed, but from a complex income perspective, Gone are the days where people are working Monday to Friday, 9 to 5. More and more people are reliant on bonuses, on commission, on overtime, on banking hours. People may have second jobs. You have a number of people who are employed, but they have a property portfolio and they're relying on the income on that. The good news is that TML, we can take multiple income streams into consideration, which then in turn will then maximize your customer's ability to borrow as much money as possible. And this is where, again, I would say, look, if you're not sure what we will take, what we won't take, if you're not sure what lenders will consider different income streams, speak to the experts who will know.
Brilliant.
I think one of the biggest area that we're seeing more of our business come from, more of our inquiries come from in the residential space, especially, is around adverse credit. It's something that's always existed, and it's something that is unfortunately probably only going to get worse before it gets better as a country. So we actually did our own sort of like market research on a cross section of customers or potential mortgage customers in the UK, and it was quite noticeable how prevalent mild to heavy adverse actually is. And these are customers who are, what we don't want is customers to think, well, I've missed a payment here, or this has happened, I've defaulted on this, I can't get a mortgage for however many years. Well, no, actually you can. So in the research that we did, it was within the past 2 years, 6% of the population has missed payment. 4% of the population have missed more than one payment. So this is just within the last 2 years. So this isn't historic adverse. This is very much happening right now. So these are your customers that you are going to be seeing. And as I've alluded to, when we're talking about the cost of living, bills going up, your gas and electric more than doubling in many cases, fuel prices going up, customers have got less and less disposable income. If they haven't necessarily got savings reserves, then they are potentially in a situation where if they've got loans, credit cards, and other debts, they may well miss payments on these. These customers are still going to potentially want to move house. They are going to want to buy houses. It's making sure that you lean on the knowledge and support of yourselves at Impact to make sure that you are not discounting a customer who has had a recent credit blip, because we absolutely have solutions for them. And I'll touch upon it, and you've kindly mentioned it as well. We have a range which is available semi-exclusively via specialist distributors called our LUMI range, which allows for some quite recent and quite significant levels of very recent adverse. And it's really important that you are understanding what lenders can do to support you with these customers.
Sure. But yeah, it's the best way throughout the whole market is to try and get that person back on a credit repair type scenario and work towards getting them back onto the high street as quickly as possible.
Yeah,
and that's great that you've got accommodation and your appetite to help those sort of customers.
TML, we know our place in the market. A lot of specialist lenders in the residential market, and TML is no different in that we know our place is very much, we are an immediate solution for that customer. They've seen a house, they've got their deposit, they want to buy it now. We can help them with that. Realistically, they'll be with us for maybe 5 years maximum. And the idea is that they will then get some stability in their self-employment income, or their credit profile will improve, and then they'll be able to move to another lender, a high street lender, for example, who will provide a lower rate than what we will provide. But we are very much that means to an end. We're that immediate temporary solution. So yeah, absolutely, that's where we can provide an opportunity for mortgage brokers out there to, rather than turn that customer away, let's give them an immediate solution now, and then you're going to be able to rewrite that business in a few years' time.
Excellent.
And then the final part of our what we call our 4 pillars of lending is around buy to let. So the buy to let market is growing. Landlords are taking probably, I'll say, a bit of a battering over the last few years. It's a bit of a vote winner in my opinion, to increase taxes on landlords, increase stamp duty on landlords. However, properties still provide a good return, as whether that's a yield or through capital appreciation. So for landlords, there is absolutely still a big market out there, and it's something that we do a lot of. We have things like no portfolio limits. We lend up to the age of 95 on our buy to let range. No minimum income, things like that. So there's a number of ways and solutions that we can provide to the buy to let market. I think the buy to let market has already been through quite a period of transition, and it is going to continue to go through a period of significant change. I think there's a consultation going on at the moment in relation to energy efficiencies of buy to let properties. And it's expected that from 2025 that there will be a minimum requirement for buy-to-let properties to be an EPCC rating. At TML, we are working on, and we will be launching in the not too distant future, our own solution for sort of, green mortgages, for want of better terminology. But landlords, they are going to need that support from the broker community, and obviously from the specialist distributor community as well, to know what lenders are going to provide them with solutions to support them with potentially the need to improve their EPC rating and make sure they're doing it in the most financially efficient way. So yeah, I think in summary, looking at what we do as a lender, there's loads of things that we can support you with, all in the specialist space. You are not going to see TML competing with the high street lenders based on, bottom line rate. The specialist market is a very competitive market. There is some good value out there, most definitely. Your customers who are self-employed, they've got complex incomes, they've got some adverse credit, or you're a buy-to-let, whether it's a first-time landlord or an experienced landlord, or somebody who operates in the more complex buy-to-let spaces such as HMOs, multi-units, expats. All of these things are things that we can help you with, and that we work very closely with you guys at Impact to make sure that your team's knowledge is, they know it's inside out, so they know what we can and what we can't help with.
Yeah, that's good. And there's a lot more to come on the buy-to-let side, because I think it's very confusing for every landlord at the moment. The fact you don't do the back book, the stress test of the back book, though, is good.
Yeah, absolutely. And that's where, we do get those big portfolios, because the back book isn't assessed the same way as many other lenders. And then I think I've already touched upon it as well. This is the LUMI range, which is available via specialist distributors such as yourselves at Impact. And obviously, thank you for your support with this, Dale, because it's a really, really valuable product, and a really, really good, like I've said, immediate solution for customers. Sure. And so it's odd, like I said, any advisors out there who have got customers who have got some quite recent adverse, I'd absolutely recommend they contact their specialist distributors, because you guys know it, the ins and outs of it. The main bullet points or the main headline features of it, you can see we allow up to 4 missed mortgage payments in the last 2 years. As long as they've not missed a further payment in the last 12 months, then the LUMI range is available for these customers. And these are loans up to 75% as well. We're not asking them to be putting down 50 or 40% deposit or equity. They can do it with only a quarter of the equity in the property. I think this is something that we spoke about it before we start recording, and something that I expect that we are going to see more and more of as well. Absolutely. It's the way that we look at defaults on utilities and communications. Utilities, especially with what's going on at the market, and like I say, the energy crisis and the cost of everyone's gas and electric bills, for example, we will ignore those. So you can have very, very recent issues, current issues, and that won't affect your ability to borrow, and we can support you with the LUMI range and our core ranges as well. CCJs, there's no limit on the number or value.
So let's go back to that one again. So defaults and utilities and telecommunications are totally ignored. Yeah, it's brilliant. Okay.
Yeah. Okay. So it's something that, again, you may not have seen it for the last 12 months. You'll see more in the upcoming 12 months than what you would have done in the last 12 months.
Sure.
CCJs and defaults, there's no value, no monetary value. We just have a numerical limit. So within the last 2 years, we can consider 3 CCJs and we can consider 4 defaults, as long as there's been none in the last 6 months as well. And this is aside from the telecommunications and utilities. And then some of the more, the more sort of quite significant adverse well. So people who have actually had an IVA or have been declared bankrupt. Yeah. As long as they've been discharged for at least 12 months, the LUMI range provides a solution for that type of customer as well. And also as well, payday loans. So payday loans, they are almost like, I think, to be honest, there's a lack of knowledge as to the detrimental impact a payday loan can actually have on your ability to obtain a mortgage. I think, a few years ago, I was an advisor, and I remember vividly speaking to a customer who had taken payday loans because they thought it improved their credit rating. Yeah, we've heard that a few times. Yeah. And it's, it's sort of quite alarming that there's probably still some of that sentiment out there. However, people will be relying on payday loans potentially because of the short-term stresses on their finances. So from our perspective, we will allow a customer to have taken a payday loan in the last 12 months. And we will lend to those customers on our LUMI range. I think the 2 overriding things with all of this is, you've got debt management plans. There's over 250,000 active debt management plans in the UK. I jotted something down earlier. There was over 500,000 phone calls and referrals to Step Change in 2020 for debt advice. So debt is very much out there. One of the big advantages of our proposition is that we do, obviously, and this is where it's really, really important to get the right advice, and that from a compliance perspective, we do allow debt consolidation as well. So it may well be that they have got high levels of debt and they are struggling with their debts, as we can see with missed payments and defaults and CCJs. They may want to consolidate those to bring their overall monthly payment down to help with their finances. We've got the solutions for that, and it's done in a way to make sure that those debts are cleared. So, like I say, the LUMI range does provide some really, really good solutions, immediate solutions for customers who have been not shunned, but whose borrowing potential with the high street lenders and other lenders just isn't there. And like I said, these loans are available up to 75%. It is via specialist distribution. So if you've got a case out there, pick up the phone, have a chat with Dale's team, and like I say, let's see if we can help you.
Absolutely.
So yeah, like I said, I've done a bit of a summary, but in summary, our 4 areas that you want to be looking at: self-employed, complex incomes, credit impairment, especially that LUMI range, but also buy-to-let. There's plenty of things that we can help you with.
That's really good. Thank you for that. So at the moment, we're seeing a lot of lenders who have taken on a lot of business because the rates have been really, really good, and not being able to cope with it so much. So where do you stand at the moment with your service levels? Service levels,
they're a little bit stretched at the moment. I'll be completely honest with you. They're not where we want to be, but I think the main reason for that, like you said, we've been as busy as we've ever been. I think April was our busiest ever month. We're not going to be too far away from that for June as a month as well in relation to new business applications. I think one of the main reasons that ourselves and I'd say other lenders who may be experiencing some service pinches are probably in this situation is that desire to add value to brokers and customers. So, as a securitization based lender, we rely on the money markets, we rely on swap rates, etc. for our funding. That market is significantly more expensive than what it was 12, 18 months ago. Let's just say it was, if the difference is approximately say 2% in the cost of borrowing for us as a lender, we haven't seen our rates go up by that same 2%. So we're taking, for want of a better term, taking a bit of a hit on that to continue to add that value. And it's not sustainable long term, but it's been a bit of a conscious decision to get as much business through the door now at potentially better rates, better cost, as much value as we possibly can. But however, you're absolutely right. Service does form part of the advice that advisors give as well. So we've taken steps to bring our service levels down to a level that we want them to be at, and hopefully in the next couple of weeks we'll be in a better position and a position that we want to be in.
Great. No, thank you for your candid honesty on that one. The other part of the market which is really struggling at the moment is valuations.
Yes,
and we're seeing quite a lot of down valuations. Is that the same with TML, or is it just area specific, or what's the scenario currently?
I think with down valuations, it's always the term down valuation is always not an interesting one, but I think fundamentally, valuers, they're qualified individuals, and with TML we ask them to give us comparables. So if they've made a decision, if they've gone and valued a property, let's say it's a 3-bed semi, where I live in the Midlands, you can probably get a 3-bed semi for say £200,000. We would expect them to give us comparables. If they value that property at 175, for example, we would expect them to give us comparables to explain, to justify, for want of a better term, how they've come to that valuation. It is quite an interesting one, because typically valuations are based on comparable sold prices, and when we say sold, not agreed sales but completed prices. The market, as you know, has been very buoyant. There's been government stimulation in relation to stamp duty holidays and things like that as well, and it's been a very, very active market. So house prices have gone up quite quickly. I expect they will probably level out a little bit. We are seeing occasional valuation challenges, but not too many. So I don't know how prevalent that is.
We've seen it with some purchases as well, where the purchase price is coming under value as well. So it has caused a few issues.
I'd expect to see, if there were down valuations or valuation challenges, I'd expect to see them more in the remortgage market, because fundamentally, I have an intrinsic value of what I think my property's worth, and the value may not agree. But with purchase, that that's where it can be a bit more frustrating. I totally agree, because if I think a house is worth that much and I'm willing to pay it, surely that's its value. But then it's a very difficult job for valuers. I'd never want to be in a situation where it's lender versus value, because absolutely they provide a service, and we sort of have to hang off that.
So we're coming to the end of 5 months into the year.
Yeah.
Where do you see volumes going for the rest of the year? So it's obviously been a very good start.
Yeah.
Rates have been, historically low and so on and so on, but they're not anymore, and everything's creeping up, and bank base is expected to go up again over the next couple of months. Where do you see volumes for the next?
Yeah,
next half of the year.
Yeah, I think it will. I think you're absolutely right. The first 4 or 5 months, and especially with ourselves at TML, the last 3 months have been very, very busy. From our own perspective, we will slow down volumes to make sure that we can get back on top of service.
Yeah,
I expect the market. I don't think it's quite a frenetic pace. I do expect there will probably be a bit of a leveling off as well in the market. So it will be interesting to see. I think the thing that I expect, and hopefully it isn't the case, but it may well be quite a challenge, is I've alluded to, the securitization funded lenders out there. And we've seen 1 or 2 lenders have already stopped lending and withdraw from the market.
Yeah.
So I wouldn't be surprised if there are maybe 1 or 2 more casualties or amalgamation of lenders. So potentially like mergers, buyouts, etc. But I think fundamentally, I think lenders will still be willing to lend. Those that can lend and are able to lend will continue lending. But like you said, I wouldn't be surprised if the market becomes a little bit more expensive just because of the the environment that we're currently working in.
Cool.
I think, just I would add, there is absolutely a need for, TML included, lenders to innovate and provide
100%.
greater solutions. Like I said, the cost of living, when you're looking at affordability, house prices going up quicker than wage inflation. Obviously, there's a consultation about relaxing the stress rates on reversionary rates, which will help somewhat. But absolutely, I still think more needs to be done. Help to Buy is coming to an end as well. That's another challenge that the new build market's got to address, and lenders have got to evolve to provide solutions to continue to support the new build market as well.
Yeah. Brilliant. That's been really useful. Thank you for your time, Chris.
No, thank you for having me, Dale.
And that's a great insight to TML and what they can offer and help you and your customers, obviously with Impact in the background there as well. So thank you for your time. Thank you for watching. Keep an eye out. There'll be more of these coming soon. But in the meantime, stay safe, keep well. Thanks very much.
Thank you.